On a quiet weekend in early 2025, when financial markets were supposed to be closed, something unprecedented happened. Senior officials from the Federal Reserve, representatives from JPMorgan, Goldman Sachs, and HSBC, and key figures from the U.S. Treasury Department convened an emergency call. The topic? Silver. Not gold. Silver. Within 72 hours of that call, COMEX registered silver inventory dropped by another 18 million ounces. Major refineries reported allocation delays stretching into 2026, and institutional buyers began offering premiums up to 40% above spot price for immediate physical delivery. The officials on that call knew something the public didn't, and they knew the control mechanism was breaking. And they knew what comes next could reshape the entire monetary system. What was discussed in that emergency weekend call? Welcome to Financial Revelations, where we decode the strategic shifts happening behind closed doors in global markets. Now, before we dive deeper into what that emergency call revealed, if you appreciate serious financial analysis that treats you like the experienced decision maker you are, not like someone who needs hype or entertainment, would you take just a moment to subscribe to this channel? Think of it this way. You've spent decades building your understanding of how markets really work. You've seen booms and busts. You know the difference between noise and signal. This channel exists for people exactly like you, people who want strategic intelligence, not speculation. So if that resonates with you, click that subscribe button. We'd be honored to have you as part of this community. And one more thing, drop a comment below and let us know, where in the world are you watching this from? Are you watching from the United States, Europe, Asia, South America? We have viewers from 47 countries now, and it's always fascinating to see where serious investors and business leaders are paying attention to these developments. Now, let's get into what that emergency weekend call revealed and why it confirms everything we've been tracking about the $80 silver thesis. The call was scheduled for 11:00 p.m. Eastern Time on a Saturday night. That detail alone should have raised alarms across the financial world. In the highly structured universe of global finance, weekend emergency calls don't happen unless something fundamental is breaking. Markets are closed, traders are offline, executives are unreachable. The entire financial machinery is designed to pause, reset, and prepare for Monday's opening bell. But on this particular weekend in early 2025, that rhythm was shattered. Senior officials from the Federal Reserve's open market desk joined the call. Representatives from the U.S. Treasury's Office of International Affairs were present. And perhaps most telling, executives from the world's largest bullion banks, JPMorgan Chase, HSBC, and Goldman Sachs, were all connected on the same secure line. The subject of discussion was silver, not a stock market crash, not a banking crisis, not even gold, which typically commands far more attention in times of monetary stress. Silver. For those who understand how commodity markets actually function, this was the equivalent of seeing smoke pouring from a building that's supposed to be fireproof. Silver markets have operated under a specific control mechanism for decades. The COMEX futures exchange in New York has served as the global price-setting mechanism, using a fractional reserve system similar to banking. A relatively small amount of physical silver backs a much larger volume of paper contracts. This system worked smoothly for years because most contract holders never demanded physical delivery. They settled in cash, they rolled positions forward, they treated silver futures like any other financial instrument, something to trade, not something to own. But something changed in 2025 that fundamentally altered this dynamic. In January of that year, the United States government officially designated silver as a critical mineral under federal strategic resource classifications. This wasn't a symbolic gesture or a political theater. Critical mineral designation carries specific legal and economic implications. It means the government has determined that the material is essential for national security, economic security, and supply chain resilience. Silver joined a short list that includes lithium, cobalt, rare earth elements, and other materials where geopolitical competitors, particularly China, dominate global supply chains. The designation authorized several immediate actions. Government agencies could now establish strategic stockpiles. Defense contractors could prioritize silver acquisition for military applications. Technology companies could justify building private reserves for supply chain security. Most importantly, the designation sent an unmistakable signal to corporate America. Securing long-term physical supply of this metal is now a strategic imperative, not just a procurement decision. According to research from the Federal Reserve Bank of St. Louis on commodity market structures, critical mineral designations historically trigger major behavioral shifts among institutional holders. Companies stop operating on just-in-time delivery models. They begin building strategic reserves. They move materials from exchange warehouses into private storage facilities. They negotiate long-term contracts with miners and refiners, locking up future production before it even reaches the market. This is exactly what began happening to silver inventories on the COMEX exchange. Within weeks of the designation, analysts tracking warehouse reports noticed something unusual. Silver was disappearing from the registered category at unprecedented rates. Registered inventory represents metal that is available for delivery against futures contracts, the physical backing for the paper trading system. When silver moves from registered to eligible status, it means the owner has withdrawn it from the tradable pool. The metal still sits in COMEX-approved warehouses, but it's no longer available to settle contract obligations. It's the commodity market equivalent of a bank depositor saying, I'm keeping my account here, but you can't lend this money out anymore. It's mine, and I'm holding it. For a fractional reserve system, this creates an existential problem. Banks don't keep enough cash in their vaults to cover all deposits simultaneously, because they operate on the statistical assumption that most depositors won't withdraw everything at once. The COMEX silver market worked the same way. The exchange maintained a fraction of the physical metal needed to cover all outstanding paper contracts, assuming most would settle financially rather than through physical delivery. But when corporations and governments start pulling metal out of the registered category for strategic reserves, that assumption breaks down. And that's what prompted the emergency weekend call. By the time those officials connected on that Saturday night, COMEX registered silver inventory had fallen below 40 million ounces, a level not seen since the last major delivery squeeze in the market. The control mechanism was failing, and everyone on that call knew what happens next. To understand why experienced bankers were connecting on emergency calls during weekend hours, one must first understand the elegant deception that had governed silver pricing for nearly 4 decades. The system wasn't illegal. It wasn't even particularly hidden. It was simply mathematical leverage applied to physical commodities in ways most market participants never bothered to question. Here's how the mechanism actually worked. A mining company in Peru extracts silver from the ground. That physical metal gets refined, cast into bars meeting London good delivery standards, and transported to COMEX-approved warehouses in New York, Delaware, or Chicago. Once registered with the exchange, those bars become eligible to settle futures contracts. But here's where the mathematics become interesting. A single 1,000-ounce silver bar sitting in a warehouse can support dozens of futures contracts simultaneously. Traders buy and sell these contracts, agreements to deliver or receive silver at specific future dates, without any intention of touching physical metal. They're speculating on price movements. When contracts expire, they settle the difference in cash and move on. This creates what financial engineers call leverage. 1 ounce of physical silver can support 10, 20, sometimes 50 ounces worth of paper contracts. As long as most participants settle financially, the system functions smoothly. The small amount of physical metal acts like a reserve backing a much larger volume of trading activity. Banks and institutions holding short positions, betting that silver prices would fall or remain stable, could maintain those positions indefinitely with minimal physical metal backing them. They collected premiums from selling contracts. They profited from the contango structure of futures curves. And most importantly, they influenced price discovery through sheer volume of paper contracts traded. For decades, this worked flawlessly. Silver prices remained suppressed relative to production costs, industrial demand, and monetary metals fundamentals. Mining companies struggled with thin margins. Investors looking at gold to silver ratios saw persistent anomalies they couldn't explain. But the COMEX pricing mechanism continued grinding forward, setting global spot prices through futures markets rather than physical transactions. Then came the critical mineral designation of 2025. What happened next wasn't panic. It wasn't a coordinated attack on the system. It was something far more dangerous to the fractional reserve model, rational strategic behavior by sophisticated institutions. Defense contractors examined their supply chains for weapon systems, radar equipment, and advanced electronics. All of them required silver, not paper contracts promising future delivery, actual physical metal arriving at factories on predictable schedules. These companies looked at geopolitical tensions with China, potential supply disruptions from primary producing countries, and the government's critical mineral designation, and reached an obvious conclusion. We need to own this metal outright, not depend on just-in-time delivery from commodity exchanges. Technology companies manufacturing solar panels, electric vehicle components, and 5G infrastructure ran similar analyses. Their procurement departments began requesting physical delivery rather than cash settlement. They negotiated directly with refiners. They built private storage facilities. Even institutional investors, traditionally content with paper exposure, started questioning their positions. If the U.S. government considers silver strategically critical, perhaps holding physical metal provides better portfolio protection than futures contracts that might not deliver during genuine supply crunches. This collective shift in behavior created a mathematical problem that no amount of paper contract creation could solve. The COMEX warehouse reports, published weekly, began showing a pattern that had only appeared during previous major market dislocations. Registered inventory, metal available for delivery, started falling, while eligible inventory remained flat or even increased. Metal wasn't leaving the warehouses entirely. It was simply being reclassified by owners asserting control over specific bars. By late February 2025, registered silver had dropped to 42 million ounces. That sounds substantial until compared against open interest, the total number of outstanding futures contracts. Each contract represents 5,000 ounces, with open interest typically running above 150,000 contracts. The paper claims against physical metal had reached levels where even a modest percentage demanding delivery could drain remaining registered inventory completely. The banks, holding large, short positions, faced an uncomfortable reality. They had sold contracts assuming cash settlement, but if even 10% of contract holders demanded physical delivery, there wouldn't be enough registered metal to fulfill those obligations. Defaulting on delivery obligations at the COMEX would destroy confidence in the entire futures market structure. It would call into question decades of price discovery mechanisms. It would validate every conspiracy theory about precious metals manipulation. And it would trigger the exact price surge those short positions were designed to prevent. This was the crisis driving that weekend emergency call. The control mechanism wasn't just weakening, it was approaching mathematical impossibility. What makes a financial crisis truly dangerous isn't the moment of collapse. It's the silent repositioning that happens beforehand, when informed players move assets while the broader market remains unaware. In the silver market during early 2025, this repositioning was happening in plain sight, buried in warehouse reports, refinery allocation schedules, and corporate procurement contracts that nobody outside specialized circles bothered to read. The smartest money wasn't panicking, it was simply leaving. Start with the refineries. These are the critical choke points where raw silver gets transformed into investment-grade bars and industrial feedstock. In normal markets, refineries operate with relatively short lead times. A corporation needing silver cathodes for electronics manufacturing could place an order and receive delivery within weeks, perhaps a month during busy periods. By March 2025, those lead times had stretched to extraordinary lengths. Heraeus, one of the world's largest precious metals refiners, quietly informed major clients that new orders for silver products were being scheduled into late 2026. Not weeks, not months, nearly 2 years out. The company didn't issue press releases about this. They simply updated delivery schedules and private communications with long-standing customers. Other refineries followed similar patterns. Metalor in Switzerland extended timelines. Valcambi adjusted allocation priorities. The Royal Canadian Mint began rationing silver product availability, even for authorized dealers. These weren't production problems. The refineries had capacity. What they lacked was feedstock, the raw material flowing from mines and scrap recovery operations. And what little material they did receive was increasingly being diverted to fulfill long-term contracts negotiated months or years earlier, before the critical mineral designation changed strategic calculations across entire industries. This created a fascinating dynamic in physical markets completely disconnected from COMEX futures pricing. While paper silver contracts traded at spot prices around $28 to $30 per ounce, actual buyers seeking immediate physical delivery faced a different reality. Premiums, the amount above spot price that dealers charge for real metal, began climbing steadily. Retail investors noticed this first. Silver eagles that normally carried $3 to $4 premiums started selling for $8 to $10 over spot. Bulk purchases of 1,000-ounce bars, which typically traded near spot price, began commanding premiums of $2 to $3 per ounce. But the retail market was small compared to what was happening institutionally. Corporate buyers weren't publishing their activities, but industry insiders began noticing patterns. A major defense contractor quietly secured a 5-year supply agreement with a primary mining operation, locking in prices and guaranteed delivery schedules. A technology consortium pre-purchased an estimated 15 million ounces of future mine production from projects still under development. These weren't speculative bets. These were Fortune 500 companies, treating silver the same way they treated other strategic inputs, as something requiring secured, long-term physical supply regardless of current market pricing. The geopolitical dimension added another layer of urgency. China had spent 2 decades dominating global supply chains for critical minerals, rare earth elements, lithium processing, cobalt refining. Beijing controlled production and processing capacity at levels that made Western governments deeply uncomfortable. The critical mineral designation for silver was explicitly designed to prevent similar dependence in this market. But preventing future dependence required immediate action. Government stockpiling programs, authorized under the critical mineral designation, began purchasing physical silver through mechanisms designed to avoid market disruption. These weren't massive open market purchases. They were negotiated transactions with miners, strategic releases from secondary sources, and long-term supply agreements that bypassed exchange pricing entirely. The U.S. Defense Logistics Agency, responsible for maintaining strategic materials for military applications, increased its silver acquisition budget by 340% in fiscal year 2025. That number appeared in a procurement document that received virtually no media attention. But it represented millions of ounces being removed from commercial markets and placed into government reserves. Meanwhile, the banking institutions, holding large short positions on COMEX, faced an increasingly difficult decision. They could attempt to source physical metal to cover potential delivery obligations, but doing so would require purchasing in a market where available supply was evaporating. Large buy orders would push prices higher, making their existing short positions even more expensive to maintain. Alternatively, they could hope that demand for physical delivery would remain modest, allowing them to continue rolling positions forward and settling in cash. But hope isn't a risk management strategy. By April 2025, three major bullion banks had collectively reduced their net short positions by approximately 85 million ounces. They didn't announce this. The data simply appeared in commitment of traders reports published by the CFTC. Other market participants noticed. Some understood the implications. The institutions with the deepest knowledge of silver market mechanics were quietly withdrawing from positions they had held for years. That repositioning told a story more clearly than any emergency weekend call ever could. The people who built the control mechanism were dismantling their own exposure to it. There's a particular moment in every market dislocation when price and reality begin their inevitable convergence. For silver, in 2025, that moment arrived not with dramatic headlines or market crashes, but through the steady accumulation of mathematical certainties that even the most sophisticated financial engineering couldn't postpone indefinitely. The $80 price target wasn't speculation. It was arithmetic. Begin with the supply deficit. The Silver Institute's annual report, published in May 2025, documented a physical market shortfall of 215 million ounces for the year. This wasn't projected demand exceeding supply. This was actual consumption. Silver permanently removed from available inventory through industrial use, jewelry fabrication, and physical investment, outpacing new mine production and recycling combined. A deficit of that magnitude would normally trigger price adjustments, bringing supply and demand back into balance. Higher prices would incentivize increased mining production, encourage recycling of scrap material, and reduce marginal demand from price-sensitive applications. But critical mineral designation fundamentally altered this equation. Governments don't reduce strategic stockpiling because prices rise. Defense contractors don't substitute alternative materials in weapon systems because silver becomes more expensive. Technology companies building supply chain resilience don't cancel long-term contracts due to price volatility. These participants have removed themselves from normal price elasticity calculations. This created what economists call inelastic demand meeting constrained supply, a condition that historically produces exponential rather than linear price movements, then layer in the monetary dimension. Since 2020, global monetary base expansion had increased the total supply of dollars, euros, yen, and yuan by approximately 40%. That newly created currency didn't disappear. It existed in financial systems, searching for stores of value that couldn't be inflated away through additional printing. Gold had already responded to this reality, reaching new nominal highs above $2,400 per ounce. But the historical gold to silver ratio, the number of silver ounces required to purchase 1 ounce of gold, remained stubbornly elevated at levels above 80. For most of recorded monetary history, that ratio traded between 15:1 and 40:1. Even during periods of silver's lowest relative valuation in modern markets, the ratio rarely sustained levels above 80.1 for extended periods. The 2025 ratio approaching 85.1 represented either profound undervaluation of silver or a permanent structural change in the metal's relative monetary properties. Market analysts, applying historical mean reversion to current gold prices, produced remarkably consistent silver targets. If gold held at $2,400 and the gold to silver ratio reverted to 60.1, silver would trade at $40. At a 50.1 ratio, silver reached $48. At the 30.1 ratio that prevailed during previous monetary stress periods, silver would exceed $80 per ounce. But the most compelling evidence supporting higher price targets came from the futures market structure itself. By mid-2025, the COMEX silver market exhibited what traders call backwardation, a condition where near-term delivery contracts traded at higher prices than contracts for future delivery. In normal commodity markets, futures prices exceed spot prices due to storage costs, insurance, and financing charges. This relationship, called contango, reflects the carrying costs of physical inventory over time. Backwardation signals the opposite: immediate physical metal commands, a premium over promises of future delivery. This condition appears when market participants doubt the reliability of future delivery or when current physical scarcity outweighs normal carrying cost economics. During the emergency weekend call that prompted all this analysis, backwardation in silver futures had reached levels not seen since the Hunt Brothers silver corner of 1980, an episode that ended with silver briefly trading above 50 per ounce. The parallel wasn't perfect. The Hunt brothers were individual speculators attempting to manipulate markets. The 2025 situation involved governments, defense contractors, and technology companies making rational, strategic decisions about supply chain security. But the market structure implications were similar. When current demand for physical metal exceeds available supply, and when sophisticated participants question the futures market's ability to deliver against contracts, price discovery breaks down. The emergency weekend call represented an acknowledgement of this breakdown at the highest institutional levels. Officials weren't discussing whether the control mechanism would fail. They were discussing how to manage the transition when it did. They were calculating potential price impacts. They were gaming out scenarios for COMEX delivery defaults. They were preparing contingency plans for a market structure that had governed silver pricing for 40 years, simply ceasing to function. And they were doing this while silver still traded below $30 per ounce on paper markets. The gap between that price and physical market reality couldn't persist indefinitely. Physics has a useful principle. Systems under stress seek equilibrium. Markets are no different. The stress building in silver markets, registered inventory depletion, refinery allocation delays, backwardation, critical mineral stockpiling, currency debasement, was creating conditions where equilibrium could only be reached through dramatic price adjustment. Whether that equilibrium point was $50, $80, or higher depended on variables no emergency weekend call could control: how quickly registered inventory depleted, whether any major contract holder demanded delivery that COMEX couldn't fulfill, and how aggressively governments pursued strategic stockpiling. But the direction was certain. The only question was timing.